Hi everyone, I'm Paul and welcome to my ICT Concepts video on mitigation blocks and how to use them. Mitigation blocks are one of the PD arrays that ICT teaches, and to be honest, they're probably one of the least talked about. But as you'll see from this video, they can be a powerful supplement to your trading toolkit. So if you're struggling to understand what mitigation blocks are and how to use them, then this is the video for you. But before we jump into today's video, there's something you need to know. I work really hard on putting these videos together for you, and I know that they create a lot of value. But you need to know that these videos aren't free. Now the great news is that you don't need to pay with any money. All you need to do is subscribe to my channel if you haven't already and give this video a like. That's it. Let's call this our gentleman's agreement or our lady's understanding. This is our social contract because I can't look over your shoulder and make sure that you're doing it. So I'll keep making high quality videos for you guys, and all you need to do is keep liking and subscribing, which sounds like a pretty good deal to me. And besides, everyone's doing it, and so you should too. Lastly, if you'd like to hear more from me and join a community of like-minded traders, then make sure you check out the link in the description to subscribe to my free weekly newsletter and to join our Discord. Now that that's out of the way, let's jump into today's video. Today's ICT Concepts video is on mitigation blocks, and we'll just run through a quick outline of what we're going to cover in today's video. So our first section is going to be on PD arrays and the mitigation block, and then we're going to go into what is a mitigation block. And then we'll go into the concepts behind why we would use a mitigation block. And then finally, we'll go through how to use mitigation blocks in our trading, along with some practical examples to help consolidate your learning. So our first topic in today's video is PD arrays and the mitigation block. Now you'll recall from our ICT Concepts video on PD arrays is that our PD array is effectively a hierarchical stack of ICT's concepts, and they sit in both a premium and a discount part of the PD array. Now above equilibrium we have our bearish PD arrays, and below equilibrium we have our bullish PD arrays. So the first PD array that we're going to be talking about is our mitigation block. So you can see above equilibrium we have our bearish mitigation block, and below equilibrium we have our bullish mitigation block. So we're going to be talking about both of those mitigation blocks in the rest of the video. So in this next part of the video, we're going to start stepping into the theory and talk about what is a mitigation block. So if we look at the price action that we've got mapped out on the slide, you'll see we have a high time frame point of interest. So we generally have our trade framed around a high time frame point of interest, be that a previous high or an imbalance, somewhere where there's going to be buy side liquidity residing. So you'll see we have the market trading up towards that point of interest. So we're in a bullish trend. You can see we create a swing high and then the market pulls back and we create this short-term low here. The market then rallies again, but you can see this swing high here is actually lower than the previous swing high. So we have a lower high. The market then trades lower again. We break the short-term low, which creates our market structure shift. The market then trades back higher into this zone before then selling off. And so where in the price action is our bearish mitigation block? So we need to bring our attention to our lower highs. So we have this swing high here. So this one's obviously higher than this one, but this swing high here is lower than this one. So we want to look between that to the short-term low, which is just here. And we want to look for the last down close candle before the market structure shift. So you can see I've illustrated that with a down close candle here, and then highlighted that with a pink box, which I've just drawn across, which gives us our zone of interest that we're going to be looking at. So you can see the market trades higher. We have our market structure shift. The market comes back up into this area, so that pink box, and then price reacts to that and then trades lower. So that's how we would find our bearish mitigation block. Now, as you'd expect, our bullish mitigation block is essentially the same thing, just the reverse. So we have our high time frame point of interest. So that would be a higher time frame low or a source of liquidity. So we're looking for sell side liquidity at this point here on a higher time frame. We have price trading down towards that. So we're in a bearish trend. So you can see we paint a swing low here. The market trades higher. Then we create a short-term high before the market starts trading lower again. So we paint another swing low, but in this case, our second swing low is actually higher than the first swing low here. So you can see we've delineated that again with this angled line. the market then trades higher. So we break the short-term high, creating that market structure shift. Price trades back again before then continuing higher. And so once again, how do we find our bullish mitigation block in this piece of price action? So again, we look between our two swing lows. So we have our initial swing low, which is lower than this one here, and then our next swing low, which is actually higher than this one here. So we look between that to the short-term high, which is right here. And so we look for our last up close candle before the market structure shift. So once again, I've delineated that with a green candle and then marked that out with a blue box. And you can see that price trades above that. We create a new short-term high, so we break market structure here. Price trades back in to that blue box before then trading higher. And so that's our bullish mitigation block. So now that we know what a bearish and what a bullish mitigation block are, we need to understand the concepts behind mitigation blocks so that we can better apply them to our trading. So let's start by looking at the concepts behind a bearish mitigation block. So you can see we have the same price action that we were talking about in the previous slides. So we have our high, we have that pullback to create the short-term low. And so what's happening here is we have traders going long on the pullback. So they're anticipating that this bullish trend is going to continue. So they're essentially buying on the pullback. And so what happens is price actually does start to go back up again, but we don't actually get a break in market structure here. We don't take out that previous high. We actually create a lower high. And from that lower high, the market starts to pull back. You can see we get a shift in market structure and we get this pullback, which traps these traders after this bearish market structure shift. So we have traders who are now sitting in losing positions and are trying to obviously get out of those positions. So they're looking to mitigate those losses. So naturally, as price starts to retrace back up into this zone, they're going to be closing out those positions once they breach that short-term low to mitigate those losses. And so that's why in this zone, as price retraces, we get sellers coming into the market, which drives price down and we get this reversal. So for our bullish mitigation block, we effectively have the opposite happen. So we have a bearish trend. You can see we create the low, the market then pulls back and traders are going short on this pullback. The market trades lower again, but you can see once again, we don't breach this low here. We actually create a higher low. The market then starts to trade higher and we get a bullish market structure shift. This puts all of those traders who are trying to go short into a losing position. And so now they're looking to try and mitigate those losses. So once price starts to trade downwards again and we go back into this zone of the short-term high, traders are going to be closing out their positions. So they're going to be buying these positions back to close and mitigate those losses. And so once again, these trap traders are closing out their positions here. So they're coming in and buying to close out those short positions. And that helps to drive price up. So now we know what mitigation blocks are and we know the concepts behind why we should use them. So now we get to the important bit, and that's how we should use them then in our trading. So to start off, we're going to look at our bearish mitigation block. So we're going to use the same piece of price action we've been using in the previous examples. We're just now going to layer on our trade just to frame out how we use the mitigation block. So again, we have price trading higher. It takes out this high time frame point of interest. We get that pullback to create the short-term low. The market rallies again. We create another high, but it's now a lower high than this one. The market then trades lower. We get our bearish market structure shift. The market trades back up. And so where we're going to be looking at again is between the two lower highs to the short-term low. And we're looking at the last down close candle. And so what we do now with that down close candle is we create a box from the low to the high and we just stretch that out. Now what we're going to be looking for is for price to trade back up into that area and then trade lower. So we're going to be looking at taking a short trade somewhere inside that zone. Now what I've just done here for simplicity is I've just used the mean threshold. So the mean threshold is essentially just halfway between the high and the low. And then I'm using this swing high here as my stop. So there's lots of options you could use around this. You could use this swing high here. You could use this one here. It's really up to you. If you wanted to be more aggressive, you could even use the high at the top of the candle. So as I said, that's completely up to you. And again, where you put your limit is up to you as well. You could use the low, you could use the close, you could use the mean threshold. There's lots of options there. So as I said, in this example, we've used the mean threshold and we've used this swing high here as our stop. Now, keeping in mind ICT's teachings, we're always looking for that low hanging fruit. We're always looking for that easy place to take our first partials. And so potentially I'd be looking at this swing low here as my first take profit, and then at another point of interest down here as my terminus or as my final take profit. So switching across to our bullish mitigation block now, we have price trading lower. We take out that high time frame point of interest and we create our swing low. The market retraces and we create a short-term high before trading lower again. So we have now another swing low, which is higher than the previous swing low. The market trades higher again. So we have our bullish market structure shift before the market trades lower and then trades higher again. And so, as we mentioned before, our bullish mitigation block is going to be our last up close candle at the swing high before our market structure shift. And so again, if we mark out our mitigation block from the high to the low and we just draw our box out, this is going to give us our zone of interest that we're going to look for price to trade back into. So that's exactly what happens here. And just like we did with the bearish mitigation block, I've just used the mean threshold, so the 50% level of that candle, and then I've just used this swing low here as my stop. And as I said before, you could use a whole number of places to put your stop. You could use your swing low here, you could use the swing low here, you could use the low of the candle if you wanted to be more aggressive, and then similarly with your limit, you could have the high of the candle, you could have the close of the candle, or the mean threshold. It's really up to you. And so then once again, for our take profits, we'd be looking at our low hanging fruit as our first take profit. So a sensible one would be this swing high here. And then we'd be looking at our terminus or a higher level somewhere up around here to close out our trade. So let's finish off by looking at some real life examples from our charts, because obviously this is a diagram and it doesn't always look quite so neat on our charts, so sometimes we have to look a little bit harder. And so in this first example, we're going to be looking at a bearish mitigation block set up on Bitcoin on the hourly chart. So what you can see is we have our high time frame buy side liquidity residing up here. The market has traded up. We've created our swing high here, and then the market's pulled back to create this short-term low here before trading higher again. Now we have a lower high, so you can see I've just signified that by this angled line here. Before the market's traded lower, we get our market structure shift, we get displacement, market trades back up and then trades lower here. So our bearish mitigation block, you can see, is right here. So I've marked it out in a pink box just there. So you can see this is our last down close candle in that short-term low between the two lower highs. Now in this example, you can see this candle is actually quite large and covers quite a long range. And so if you'd just taken a simple mean threshold example in this one, you wouldn't have actually gotten a fill. So there's lots of ways to do it. As I mentioned in the earlier parts of the video, you could have your limit down here at the low, you could have it down here at the close. So there's lots of options in terms of how you would place your limit in terms of entering this trade. And again, how you would place your stop is equally up to you. So you could use the high, you could use one of these swing highs. It's really up to you. And that's one of the things you just really need to do a lot of testing around. Now, one of the things you might notice, especially if you're a student of ICT's 2022 mentorship program, is there's actually a bearish fair value gap sitting in this zone here. So we have our fair value gap set up just here. So 1, 2, 3 candle formation, and our fair value gap's actually right in between there. So this is one of those examples where you can use a number of ICT concepts and stack them together. It's also good that you have confluence of those, and that's what I've used for this entry here. So I've used the bottom of the fair value gap here as my limit order, so my limit sell order, and then I've used the top of this candle here, so the high of that candle, as my stop. So in terms of our take profits, there's also lots of options here. You could target the imbalance here, or potentially this low here as your first take profit, and then your second take profit or your terminus down here at the sell side liquidity right here. So you can see if you'd entered at the low of the fair value gap here and just run that trade all the way to the sell side liquidity, you would have got a nice 3.7R trade. And for this last example, so our bullish mitigation block, we're looking at the S&P or the ES. So as you can see, price is trading lower. We create this swing low just here. The market trades higher again before coming back to that area. We get our sell side liquidity relative equal lows created here. The market stabs down into that. We take out that sell side liquidity. We trade higher. We create a short-term high before creating another swing low just here. So we have two swing lows, with this one being lower than this one. The market then trades higher again. We create a swing high, which gives us our bullish market structure shift. So in terms of where's our bullish mitigation block, we look to our swing lows, so our higher swing lows to the short-term high in between, and our last up close candle before that market structure shift. So that's this up close candle here. So we've just marked that out with a blue box from its high to its low and just stretched that out in time. Now you can see that the market trades higher and then comes back into this zone, touches it a couple of times before taking off. Now, as we talked about in previous parts of the video, there's lots of ways to trade this. You could have your limit at the upper part, so at the high of that candle. You could have it at the close. You could have it at the mean threshold, which would have worked in this example. And then in terms of stop placement, you can use your swing low, you could use the low of the candle, or even one of these swing lows down here. It's really up to you. It really comes down to your testing and what you're more comfortable with. Now, what I've done again in this example is I've used our fair value gap. So just like we talked about in the bearish example, there's actually a fair value gap sitting just here as well. And so again, we can just use this to help target our entry a little bit tighter and just build a little bit of confluence. So you can see we put our limit to buy just here at the upper part of that fair value gap, still sitting within that mitigation block. And then we're using this swing low here as our stop. Now, in terms of exits, in terms of partials, again, there's lots of ways to do this. Our low-hanging fruit options would be the buy-side liquidity that's residing above these highs here. That'd be an easy place to take a first partial, and then we could target, the buy-side liquidity up here as our terminus. Now in this example, we've just mapped it out as if we're trading for that buy-side liquidity, and you can see that gives us over a 4.6R return. Thanks for watching my ICT Concepts video on mitigation blocks and how to use them. I hope you found it helpful, and I hope you're able to integrate mitigation blocks into your trading system and analysis. Don't forget our gentleman's agreement or our ladies' understanding. I've done my part, and now it's up to you. Lastly, if you'd like to hear more from me and join a community of like-minded traders, then make sure you check out the link in the description where you can subscribe to my free weekly newsletter and to join our Discord. Thanks for watching, and I hope to see you next time.